Hey, Navy Dowdy here in the Midwest in the great Chicago area here in the United States. Part of giving good tax planning advice is understanding short-term emergency needs, but also human nature. Often, before the Tax Cuts and Jobs Act, people in a cash crunch or in other emergencies would look to their 401k for a loan. After all, that's where a great deal, if not all, of their savings are accumulated. However, there's several problems with that thought. First, a 401k isn't savings, it's a retirement plan, and the structure of the assets inside are generally not cash. So taking a loan could mean selling an asset and then losing the growth opportunity that could be critical to the fund's objective. Secondly, the rules on repayment to the 401k account might be fine while you're still an employee, but what if after you took the loan you were fired or had to quit for some reason before the loan was repaid? The 401k loan would have to be repaid in 60 days, or it would be considered a distribution. Or even worse, if you're under the age of 59 and a half, an early distribution, which would not only make it taxable income, but would result in a 10% early withdrawal penalty as well. Ouch. Example, Bob makes $120,000 a year as a floor manager for a small manufacturer. His son is in an Ivy League school and his plan has been to use a savings account for tuition, but unexpected events in the prior year left that account with a very low balance. He borrowed $40,000 from his 401k and plans to pay the loan back by paycheck deductions over the next year. He takes the loan in September. Then soon after, the owner sells the business and Bob's job now belongs to the new owner's son. He has earned $80,000 to date but is now unemployed. He also receives a PEP pay, sick and unused vacation of another $14,000. Under the old rule, he only has until November to repay the loan. Not daring to repay the loan for fear of remaining unemployed and running out of cash, he would have the following bad tax outcome: $94,000 of taxable income plus the $40,000 loan, which was not repaid within the 60 days, also becomes taxable income, plus a 10% tax penalty on that $40,000, which will result in an additional tax due of $4,000. As additional icing on the cake, his accidental $134,000 of unearned income, I should say of earned income, also puts him in a higher tax bracket. Because of this potential disastrous outcome, when asked, we would recommend funding emergencies from almost any other means, but never ever a 401k loan. But under the Tax Cut and Jobs Act, we're at least giving it new consideration. We haven't outright reversed our stance, but the new rules do expand the group of people that we might advise to go ahead with 401k loans. Under these rules, the time frame has been expanded so that a 401k loan can be repaid at any time up to the filing of the individual federal tax return on April 15th or later on extension. And this will apply to everybody who has had to borrow money and then lost their jobs for COVID following the year of unemployment or plan termination. So that creates new headaches for plan administrators, and we like plan administrators. We don't want to be creating extra headaches for them, but it is a very comfortable period of time for people to move the income into a new tax year or find footing to repay the loan and have it never become taxable at all. It doesn't change the saving assets versus retirement assets dynamic, but it is still a significant difference. And for many scenarios, may shift the answer to the should I borrow against my 401k plan question to a yes column. Get with your tax planner now if any of this applies to you. I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.